You're about to see breaking market commentary that exposes exactly why the last 24 hours shook global markets, and why investors are suddenly questioning everything. This isn't just noise. This is the kind of shift that ends up in the history books. Equities are wobbling, crypto is collapsing, and the Fed's December move is now surrounded by more uncertainty than ever. If you're holding stocks, crypto, or even cash, this affects you directly. Stay with me, because the next few minutes might change how you see the entire market.
Talk me through your view of the price action. The last 24 hours has been worth one for the history books.
Yeah, I mean, certainly. I think it all comes from a place of unease. It comes from the fact that you've got very high valuations. Yesterday, obviously, we got the labor market report for September. Now, that I don't think was particularly concerning. Yes, unemployment rate ticked up, but it was because of a rising participation rate, and that seems like it's unlikely to repeat. It's now very much a stale data print, so I don't think you can get a lot of signal from it. But the more worrying aspect of the labor market reports generally is that the November employment report, along with October payrolls, we won't get until after the December Fed. So that Fed meeting won't have that important information. And I think there was a bias within the market that those prints would come in on the dovish side. That made sense because you had the weakening that maybe looked more artificial than what was actually happening because of the shutdown in labor market data we'd expect. Yep. And so that dovishness isn't going to come through, and it means that you have some 8 basis points priced for December from the Fed. That can come out still, especially because you've had more hawkish Fed minutes. The skew of speeches certainly is leaning that direction, and so it means that the bias is for more of a sell-off in fixed income as that comes out, and certainly for equity markets to stay on shakier grounds, especially as we head into next week when we get more data. And you also have Thanksgiving, which I don't know about you, but as an investor, I wouldn't want to put on risk heading into that. I'd rather just enjoy it.
Now, here's what really matters. And this is the part most investors completely miss. The panic you just heard isn't just about unemployment or PMI numbers. It's about timing. The next major jobs data will arrive after the December Fed meeting. That means the Fed is effectively flying blind into one of the most critical decisions of the year. And markets hate a blind Fed. This is why bond yields are unstable, why equities look shaky, and why even crypto, which normally dances to its own rhythm, is reacting violently. When valuations are stretched and liquidity is tightening, even small signals can trigger outsized reactions. The real danger? If the Fed leans hawkish because they lack updated labor data, we could see a deeper pullback in risk assets. Exactly the environment where crypto sell-offs begin to spill into equities through retail deleveraging. This clip highlights something bigger. Investor psychology is cracking, not because of one data point, but because nobody trusts the next move. And this entire reaction shows you exactly how fragile the current rally is.
Does it matter, though? Does it matter what the Federal Reserve is thinking or doing or what the effect is on the bond market if the bond market feels still fairly range-bound and the correlation between the bond market and everywhere else seems to be broken?
Yeah, I mean, I think it depends on what kind of investor you are, right? If you're looking at day-to-day moves and you're worried about kind of short-term gyrations, then certainly it matters in terms of that December pricing. But further out, yeah, we're still looking at a terminal rate around 3%. That's been very firm. And I don't see anything in the next little while that really changes that if you're not having the data come in, because it's a question around neutral. There's nothing to tell you about neutral from kind of like retail sales on a monthly basis. So I think certainly if you're a longer-term investor, you can be reassured in the equity market by the fact that you've got monetary and fiscal easing into next year that may get more positive. And from a rates perspective, that terminal at 3% looks pretty firm.
Well, given the market is so shaky, or feels shaky this morning, we have PMI data out across the globe, Europe and the U.S. Could that be something that maybe shifts the bar headed into this Friday?
Yeah, I mean, European PMI data is expected to come in on the positive side in terms of composite being in expansionary territory. I wouldn't take a lot of signal from that, though, because it's relative, right? So when you had tariffs at very high levels post-Liberation Day, that's much more negative than now that we have a trade deal. I would also say from the PMI perspective that it doesn't help if you're not spending. So I think certainly there's still too much of a growth positive priced into the euro, and I think that needs to come out to its detriment.
Are we paying attention to crypto too much? The price action this morning is extraordinary, but does it matter?
Yeah, I mean, I think it's because you're already in an environment where people are worried about things, where valuations are high. Because of that, you're taking kind of any signal that you can, especially because the data is all over the place.
Yeah.
You're trying to look for places. And I think it is a relevant point that retail investors are very much invested in crypto. And so if you have sell-offs there, maybe then you need some deleveraging elsewhere. Maybe that means you get flows out of equities. But I think generally, I don't think there's a huge amount of value in what you see in crypto movements. The movements tend to be quite a lot larger. Yeah, the signal from it, because, how do you value crypto, right? Like, what's the reasoning behind it? I can't really tell you, like, why we'd be down 10% one day and up 10% the other day beyond headline noise. And so the feed through to equities, for example, which are very much a growth-driven asset, doesn't seem clear-cut to me.
This is TheCryptagon. Stay sharp, stay informed.